everybody, my name is Zoe and I decided to do my recorded presentation on the retail inventory methods, cost versus conventional. So here's a little bit of information that we're going to need to know before we begin the problem. So there are different versions of the retail inventory method: the conventional method, the cost method, the LIFO retail method, and the dollar value LIFO retail method. Regardless of which version the company uses, the IRS, various retail associations, and the accounting profession all sanction the use of retail inventory methods. We will focus on the conventional and the cost method here as stated above. Retail inventory methods are used to estimate the value of a retailer's ending inventory quickly and easily, without requiring a full physical count, allowing them to make informed decisions about purchasing and budgeting by providing a relatively accurate picture of their stock levels without significant time investment. According to PwC's website, retail inventory method, RIM, is an averaging technique used by retailers to reduce the amount of record keeping associated with accounting for inventories. In general terms, RIM allows retailers to compute an average cost to retail percentage used to value ending inventories. The use of RIM eliminates the need to maintain detailed inventory records on a cost basis and allows retail companies to price physical inventory counts at estimated cost based on the retail value of merchandise. So here are some key concepts under RIM. There are markups, which are an additional markup of the original retail price. Markup cancellations, which are decreases in prices of merchandise that the retailer had marked up above the original retail price. Markdowns are decreases in the original sales price. Such cuts in sales prices may be necessary because of a decrease in the general level of prices, special sales, sold or damaged goods, overstocking, and market competition. Markdown cancellations occur when the markdowns are later offset by increases in the price of goods that the retailer had marked down, such as after a one-day sale, for example. So here's some special items relating to the retail method. The retail inventory method becomes more complicated when we consider items such as freight in, purchase returns and allowances, and purchase discounts. In the retail method, we treat such items as follows. Freight in costs are part of the purchase costs. Purchase returns are ordinarily considered as a reduction of the price at both cost and retail. Purchase discounts and allowances are usually considered as a reduction in the cost of purchases. In short, the treatment for items affecting the cost column of the retail inventory approach follows the computation for cost of goods available for sale. In addition, a number of special items require careful analysis. Normal shortages, breakage, damage, theft, shrinkage should reduce the retail column because these goods are no longer available for sale. Such costs are reflected in the selling price because a certain amount of shortage is considered normal in a retail enterprise. As a result, companies do not consider this amount in computing the cost to retail percentage. Rather, to arrive at ending inventory at retail, they show normal shortages as a deduction similar to sales. Abnormal shortages, on the other hand, are deducted from both the cost and retail columns and reported as a special inventory amount or as a loss. To do so otherwise distorts the cost to retail ratio and overstates ending inventory. Employee discounts, given to employees to encourage loyalty, better performance, and so on, are deducted from the retail column in the same way as sales. These discounts should not be considered in the cost to retail percentage because they do not reflect an overall change in the selling price. So now that we know this information, we can go and start our question. So here is all of our information we need to solve the problem. And our question is, given the information above, calculate ending inventory with both 1, the conventional retail method, and 2, the cost retail inventory method, and explain why they produce different ending inventory. So let's take a little tour. We have our beginning inventory, purchases, purchase returns, purchase discounts, sales revenue, sales returns, markups, markup cancellations, markdowns, markdown cancellations, freight in, employee discounts, and a normal loss and breakage. So here's how I set up the problem. There's beginning inventory, purchases, purchase returns, discounts, freight in, our net markups, our markdowns, our net sales, our employee discounts, our loss and breakage, and the number we will arrive at, which is ending inventory. On the sides here, I have what we will use to find the answers and what we'll get there. So first, I'm just going to start putting in the numbers. So here's beginning inventory for the cost side, our purchases, And since we have purchase returns, we're going to deduct those. So I'm making that number a negative number so that the sum function will be used properly. I'm also subtracting purchase discounts, and we're going to make sure we add our freight in. So I'm moving on to the retail side, doing the same thing. Our beginning inventory, we're adding that. We're also adding our purchases, but we're going to subtract those purchase returns. And then I sum them all up to arrive at available for sale. Then for the cost to retail ratio under the conventional method, we need the net markups. So under the retail side, we're going to find our net markups, which is our markup cancellations, or markups less our markup cancellation. Markups less markup cancellation. And then I just bring down the number from the cost side and I sum up the number on the retail side. So this ratio is literally as it says, it's the cost to retail ratio. So we're going to find the goods available at cost and we're going to divide that by the goods available at retail. And it gives us 57%. So now we have to find our net markdowns for the cost method. So our net markdowns are our markdowns less our markdown cancellations. And since the markdown, I'm making it a negative number in Excel, so that way it can be summed up nicely. I brought down the cost number, even though nothing changed. And I brought down the retail number. I summed them up rather. And we're going to do the same thing we did for the conventional method. Retail after markups and markdowns for cost, and the retail after markups and markdowns for retail. And it gives us 57.8%. Now we have to finish the rest of the problem to arrive at ending inventory. So we're going to subtract our net sales, which is our sales revenue less our sales returns. I made it negative because we're going to subtract it. And then we also have to subtract our employee discounts and our loss and breakage as explained previously in the information. We would not remove it from the cost side. We're going to sum that up from the retail after markups and markdowns down, and it helps us arrive at ending inventory. So our ending inventory at cost under the conventional method, we're going to take the ending inventory we just calculated and multiply it by the cost to retail ratio under the conventional method. And then we're going to do the same for the ending inventory at cost under the cost method, which is ending inventory under times our cost to retail ratio under the cost method. And there we go, we have our two answers. And for the third question, the cost to retail method and the conventional retail method differ when calculating the cost to retail percentage because the conventional retail method only considers markups in its calculation, while the cost method takes into account both markups and markdowns, leading to a potentially higher ending inventory value when using the cost method compared to the conventional method. So lastly, I just wanted to show you where you'll be able to find the retail method that a retail company would employ. And this is in the Securities and Exchange Commission website. And I'm just going to search up Target. I hope everybody knows what Target is. It's a retail store. And you would be able to find these in their 10K annual reports. So for Target, it's simple. You can just go into their sections and search inventory, and it will show you what retail method they employ. So it says the vast majority of our inventory is accounted for under the retail inventory accounting method using last in, first out method. And it says at the bottom, under RIM, inventory costs and the resulting gross margins are calculated by applying a cost to retail ratio to the inventory retail value, which is what we did. So lastly, I just want to compare it to another one. So we're going to go back to the homepage and search up Walmart just to see how they compare. Going again to their 10K annual reports. This one was harder to find, so I just searched up on the page inventory method. So it says that they utilize various inventory methods to account for their inventories depending on the segment, the format basically. So their US segment uses last in, first out like Target. Their international segment uses either the RIM or weighted average cost method or the first in, first out valuation method. And their Sam's Club segment uses the weighted average LIFO method. So that is it for the retail inventory methods. I hope this was helpful. Thanks for watching. Bye.